Continuamos con la conferencia Analítica y herramientas digitales para la prevención de fraudes, a cargo de Anand, Financial Crime and National Fraud Leader for Financial Services en EY, Canadá.
Hello all, thank you very much for joining us this afternoon for a conversation on fraud analytics and prevention techniques. My name is Anand, and I'm going to be walking you through a few of these slides, talking about current trends and tips for fraud, as well as things the industry is seeing and doing today. So today we're going to have, talk about 5 different things, and then I'll leave you with some thought leadership as well in the area of financial crime and trends. But we'll start with industry pain points. What's new, what's different and changing this year. What are we seeing from a trend perspective in terms of, threats? How is the industry reacting as a result of these trends? And then just a little bit on what institutions are doing now, what they're planning for next, and what they want to do beyond that in terms of their longer term plans. And we also have a few use cases to share as well. So we'll get right into it. In terms of industry pain points, we're seeing 4 main themes. To start off, the entire industry is moving to faster digital payments. Whether it's peer-to-peer payments or large value industrial transfers, we're seeing a large movement across the industry to payments that will clear and settle in real time, which is really different from the traditional approach where payments would take, days, if not weeks, for clearing and settlement. This in large has been driven by an ISO standard for real-time transaction processing, 2022. And as more institutions move towards faster payments, what we're seeing is the need to protect those payments in real time, increases. And so the sophistication of, the minimum requirements for payment protection is significantly higher for faster digital payments. Another thing we're seeing in the industry is a sophistication and a coordination of criminals. Criminals are now coordinated in a way that they can sell their services to each other. And so, we've seen the emergence of things like business email compromise, which starts off as a cyber attack, where an institution's email is compromised. That email is then used to identify the individual and access their banking credentials, potentially send an email to the finance department and ask them to make payments on their behalf. That type of activity, which involves, cyber as well as fraud, as well as other capabilities, shows that the criminal element is getting more and more sophisticated, and the nature of their attacks are, sophistication are increasing. We're also seeing regulators react to this increasing sophistication of criminals with increasing compliance. You're seeing a lot more regulatory scrutiny on the capabilities that are used to investigate and identify criminals, particularly on when sophisticated analytic models are being used with machine learning and artificial intelligence. Regulators are increasingly interested in model validation and understanding, how that model is being evaluated from a trustworthiness and fairness perspective. And we're seeing significantly more efforts from financial institutions to want to make sure that their models, are trustworthy and fair. And so, model validation continues to increase in terms of regulatory use, as well as, clients' requirements for the need to understand, what's inside an analytic model. And finally, we're seeing crime convergence. The traditional view of, cyber criminals doing cyber acts, then stealing money and then laundering that money has really converted into an understanding that it's the same criminals that are doing this. They're essentially buying kits. And so by thinking of it as separate acts and having separate departments that look at separate data, it's much harder to identify these types of criminal acts that, combine, breach data with fraud to steal your money and then, launder that money through mule accounts. Although it's the same perpetrator, if we have 3 different departments within our organizations looking at it, it's much harder to identify and find. So that's really what's changing in the industry in terms of, things that are emerging. And here's a look at some losses. These are all in US dollars. By far, the most prevalent is, wire fraud. And we talked about this in terms of business email compromise. But outside of that, criminals are very specifically targeting employees to have access to wire systems, whether they're in banks or small businesses or large corporates. It is obvious that gaining access to those systems and the funds that are available to small to medium-sized businesses, is quite significant. As you can see, the average loss size is around $63,000 per occurrence, but based on how much you have available, millions of dollars could be stolen in a single instance with wire fraud. And, this continues to be, on the top of the list of, what companies are looking at trying to prevent. Right after wire fraud, we'd say, card fraud, which includes both credit and debit card fraud, continuously increasing globally, especially through the pandemic. It is important to note that, through the implementation of chip and PIN, card fraud losses have gone down, but digital payments, which are often called card not present payments, are still increasing. And so we are seeing a decrease in, what we're saying is counterfeit and card present transactions, but it's sort of being offset by an increase in card not present, which is actually larger than the decrease. And so overall, card fraud continues to go up. Online fraud is probably one of the fastest growing areas. Where we see card fraud is kind of stagnated, online fraud grows significantly every single year. In fact, Juniper predicts, more than almost doubling of the total online losses. And this makes sense if you consider the move to digital from both consumers as well as payments and products. I think we're going to continue to see online being a trend that increases very significantly. Now, identity fraud and synthetic identity fraud, are again where people see the future of fraud moving. This is an area that has increased every year. It continues to increase because of the data that's available as a result of breaches and mass data compromises. In the past, we saw compromises of card data where people really focused on stealing card information. What we're seeing now is a focus on identity data, where individuals can steal identity data. This is primarily because the targets for identity data are a lot softer than those for card data. With the industry increasing encryption, enforcing PCI standards for card data, we've seen the criminals start to move to other sources like universities, medical centers, insurance companies, places where personal information is plenty. And in some cases, the security isn't as good as compared to, credit card and debit cards that have been improved over the last decade and so. Finally, the last 2 here are account takeover fraud. Again, with the advances in the ability to take over one's cell phone and one's email, with things like SIM swap fraud, the potential for account takeover through telcos continues to increase. This is primarily, again, because they're being seen as the weak link. And simply by, stealing somebody's SIM, you can gain access to their 2-factor authentication passwords. And another area of significant growth is peer-to-peer transfers. So in Canada, we had email money transfer. In the US, there was Zelle. There's new peer-to-peer transfers coming out all over the world with the ability to let people move money within country and also internationally. These are also, huge targets for criminals because they generally want to use these not only to launder funds, but also to steal funds from individuals that haven't enrolled in these services yet. So hopefully that gives you a good view of, where people are focused from a loss perspective in fraud. And as I mentioned before, what we're seeing generally in the industry is a convergence of the delivery models. People have realized that something that starts as phishing or a data theft, doesn't end there. That information is then often used to either take over an account, commit first-party fraud, leverage insiders to steal more information. And these types of frauds affect all products and channels. Once somebody is operating with your identity, they're not limited to the card that they may have stolen or a check that they found in the mail. They actually have access to all products, and in fact, applications for new products. But then, once they've stolen this money and they have access to it, even if it's unsecured, they then have to make that money legitimate. And that's where the money laundering comes in, where people will start to, put in remittances, layer the funds between multiple accounts, use safe havens to move money through. And essentially, what we're seeing is organizations that start to look at these things together from a cyber fraud, insider threat, and money laundering perspective, have a significantly better perspective on the crime and actually find things much earlier in the life cycle than they would if they had a traditional siloed approach. This is especially true now because customers are interacting through lots of different channels. And, the threat for stealing data, especially on digital channels, continues to increase in both sophistication and growth. And so, having this perspective of, all crimes significantly helps in not only reducing losses, but also mitigating, human trafficking and other money laundering threats that are often part of the financial crime umbrella. So as a result of these changes, what are we seeing? We're seeing three major changes. First, software companies have started to develop financial crime platforms. So where you would go buy a fraud platform before, or an AML platform, or a cyber platform, people have realized that the capabilities that come with that platform, the ability to make decisions in real time, near real time, or batch, having a rules engine in place, an analytics environment, a case management capability, reporting to regulators, and then dashboarding are all part of a platform, that can provide services across all of the financial crime areas. So we're seeing a lot of convergence from the vendors into providing these platforms that allow organizations to look at financial crimes more holistically, and also share information between different departments. Another major trend is a move towards managed services. A lot of financial crimes can be detected better when more data is involved. So we're seeing a move to consortium solutions in the US, the UK, and Australia, also emerging in Canada, where central locations that have access to data across many financial institutions are being asked to provide managed services in terms of analytics, decision capability, and data. And those services are, in fact, improving the ability for both financial crime platforms and non-platform players to take advantage of, consortium data and capabilities. And then finally, we're seeing the emergence of adopting new technologies. Artificial intelligence and machine learning has been used in fraud probably for longer than any other discipline. Predictive neural networks, are 20 years old in terms of the use in fraud. But now we're seeing that same capability is being expanded to be able to score the digital items like the digital device, AML from a beneficiary perspective. And so the proliferation of artificial intelligence is something that's significantly improving all financial crime detection. We're also seeing new technologies that allow multiple parties to share information while maintaining privacy. This allows institutions to share known bad information without necessarily having to share personally identifiable information, which allows the industry to converge over known bad threats. We're seeing a lot of capability in the know your customer and digital customer onboarding, to leverage emerging technology for not only, new data to validate customers, but also shared data services and collaboration amongst multiple stakeholders. And so from a fintech and vendor perspective, what you see is there's, four main type of solution providers. On the top right, it's the financial crime platform we generally talked about. This is your NICE, Actimize, FICOs, Truth Technologies, SAS, IBM, BAE. They're the general platform providers. And what we said is we're seeing them start to do more. Somebody that was traditionally only a fraud player is now fraud plus AML. People that were previously cyber started to expand into AML and fraud. And so you're seeing this, this platform being developed that allows you to make business decisions irrespective of the need. Just below that, you're seeing a lot of product champions. These people focus in one area, like checks or machine learning or graph analytics, and generally solve problems irrespective of the type. So the product champions, will generally do one thing really well, and those can be integrated into financial crime platforms. On the bottom left, plug-and-play providers are really solution providers that allow you to add new data and new capabilities into your financial crime platforms. So you're starting to see a lot of plug-and-play providers open up their APIs and allow that data to be used by financial crime platforms to automate and improve their capability to make decisions. And then finally, there's regional champions. Every country, every jurisdiction, has new and upcoming fintechs, that has exciting data, different technologies that leverage open source. And so what we're seeing is these financial crime platforms and all these other players all coming together. And really, that's what's improving the ability to provide analytics. You have new data providers, new sources of data, and new platforms that have the capability to deliver, advanced analytics, in real time when necessary. Now, from an innovation in analytics, we're seeing lots of new prevention and detection techniques being used. A lot of effort has been put into contextual analytics, being able to identify information from the data that's been provided. Things like time and space calculations, understanding, the IP address belongs to a location, and that location represents, the person's physical presence. That level of contextual analytics is significantly increasing where, data is being used in its context and compared against other data sources, to identify anomalies. Correlation analysis is very important once you have, good known fraud trends. It's generally used to identify fraud once you've seen something. You're looking for other transactions that look like this bad behavior. Correlation analysis also helps in reduction of false positives. Through peer correlation analysis, you can identify what other peer groups are doing. And so, everybody buying flowers one day, a peer correlation could identify that as Valentine's Day, so it's not a problem. And so correlation analysis is still a tool that, provides significant value in not only identifying bad activity, but in reducing, false positives. Link analysis has proven important in identification of criminal rings. We're finding, especially in first-party fraud, some of these criminal rings will often reuse some of their credentials. They'll use the same address or the same phone number, or slightly vary, the phone number and address. So link analysis, can help you identify these common elements between lots of different applications and accounts, and identify either first-party fraud or organized criminals, that are operating in concert. Bundling is a capability to, organize your data such that you can compare like parties with each other. Groups of, related events are much easier to compare against themselves, than customers that may have unrelated transactions on them. And so, having these categories that are very specific to the problem you're trying to solve, again, helps in identification of broader contextual indicators that could help you identify, bad events that are occurring. In general, most of these capabilities are put together into scores. Scores are easy to use for rule bases and allows for easy interpretation and changes when needed. You can raise a score threshold and lower a score threshold if a problem area starts to come up. And so most of these analytic capabilities are output into scores and reason codes that are then used. A lot of analytics is now starting to use feedback more often. In the past, models would be trained, once or twice a year. Now, with active and continuous learning, as soon as an item is flagged as bad and you have enough bad tags, that data is automatically being used to improve the model's parameters so that they can better detect the next transaction. And so this improvement in the feedback loop, where the feedback loop is getting faster and faster, to the point where eventually, we're looking at real-time feedback, where as soon as a decision is made, the output of that decision is used to improve the next decision. Network analysis really allows for more complex issues. If you think about pump and dump and things like Ponzi schemes, where large numbers of participants are involved in committing, the crime. A lot of mule fraud activity falls into this category. It's where you're not investigating one customer or one transaction, but investigating an entire group of related accounts and transactions to try and identify a criminal network. Aggregate risk analysis is really using different scores from different areas to normalize those scores from a risk perspective. This is probably the most common things people are doing, where they'll take a device score from cyber, an identity score from the identity access team, a deposit score from the checks, and then a credit card score from the fraud team, and then aggregate those scores together to try and identify customer level risk indicators, that would not be individually identified by those individual scores. But as soon as you put them together at an aggregate level, you have the ability to identify net new types of fraud that would have missed. And finally, this concept of aggregating not only scores, but events becomes very important, especially as customers are operating across different channels. Looking at your call center separately from your digital channel may mean that the criminals all move to the call center. They generally move to the place of least resistance. And so thinking about all of your events across all of your different channels, and aggregating those, gives you the opportunity to get ahead of the criminal, that obviously for the emerging threat that we talked about has the opportunity to work across different channels and across different products. So those are the main things we're seeing from an analytics perspective. And not everybody is doing all 9 things, but depending on the problem they have, people are picking and choosing, 2 or 3 of these different things to improve their overall detection from an analytics perspective. Now, finally, what are people doing now? What do they have planned, next? And then overall, what is the longer term vision for financial crime management specifically? So first, right now, organizations are really focused on optimizing digital capabilities and automating manual tasks. Surprisingly, there's a lot of manual tasks where investigators have to go to 10 or 15 different places to collect information to be able to do an investigation. And so, automation through RPA and other capabilities is really helping in this space, where all the information is brought to an investigator to be able to make a decision. Organizations are also focused on sharing information in their own organization. Oftentimes digital teams and marketing teams and fraud teams, collections teams all have different information. At least from a financial crime perspective, we're seeing fraud, AML, insider threat, and physical security coming together. And then finally, people are also looking to identify more complex types of transaction fraud. It's understood that there's a lot of fraud that's being missed. And so, adding workflow automation and improving your processes gives investigators more time to catch more complex events. On the next category, people are really focused on the effectiveness of financial crime. It's understood that a lot of financial crime goes unreported and unnoticed. And so as institutions start to plug in their product champions and platforms and put data together, they're able to start to use intelligence decision capability to identify more complex threats and start to really identify threats that people currently today don't solve very well, like human trafficking, money laundering, and organized crime. And so that's definitely on the, on the forefront of what people want to do next, because they see it as an emerging threat. And then finally, I think in the future, people are really looking to consortium solutions, because there's an understanding that criminals play different institutions against each other. A good customer may not open 10 bank accounts on 10 different banks, but a criminal generally does. And so, having these consortium solutions where all of the, information can be shared, that is really the best platform or capability to grow and develop fraud and financial crime solutions. And especially as managed service capabilities come up in the cloud, where people can share information specifically about payments, customers, and beneficiaries, that's really the long-term value proposition, where we can really tackle crime by managed services, platforms, and consortium data capabilities. So I have a couple of use cases, and I'll just spend a minute on each. This is an example of an organization that was able to improve their transaction monitoring model efficiency. By standardizing and putting an infrastructure in place to be able to build models and provide the documentation for validation, we worked with this organization to improve their new model development time by 40%. So they could now develop and deploy analytic models much faster, which really allows them to take advantage of these capabilities for AI and machine learning, even in batch-based environments. We have another use case here where an organization was using active learning here specifically to identify new threats. This organization identified that there was a lot of fraud that the customers were detecting, and they were not catching it first. And so they put together an AI-driven solution that specifically looks at an active learning loop, to identify things that would have been missed. And they were successful at improving the ability to find brand new fraud. And the last use case here is, a model validation platform that we've worked with as a large institution, global financial institution. This essentially, as I described, allows you to look at your analytic models once they're deployed and make sure that they're trustworthy and fair and meet the regulatory requirements for model validation. And this reduced this client's model validation from 4 to 8 months to 1 to 2 months. So you can imagine, if a good model is sitting on the shelf for 4 to 8 months before it's validated, you lose a lot of the value that model would have generated if it was in production. And so, as regulators and the industry starts to do more model validation and you start to deploy more advanced analytics, it'll be important to have this capability so that you have unbiased, resilient, explainable, transparent models can perform, in real time. That was all the content I had for you today. I really appreciate your attendance today, and please feel free to send any questions to the chat. Thank you very much for your time.